In today's video, I'm going to show you how to very easily calculate your RMDs. I'll explain what they are, and by the end of this video, you'll know exactly how much you owe and what to do. I'm Raul Shah. I'm the CEO of Doc Shah Financial. We are a wealth management firm. I go over this with clients all the time to help them never pay more in taxes than they need to. The course that you're viewing is my retirement planning course that I taught at Johns Hopkins University, which is also my alma mater. So let's go ahead and get right in. RMDs are very easy to understand. RMD stands for Required Minimum Distribution. Essentially, in your tax-deferred accounts like your traditional IRA, your traditional 401k, 403b, 457, your TSP, all of these accounts have what's called tax-deferred status. So you put money into the account, you got a tax deduction very likely in the year that you did it, and all of those gains have grown tax-free for likely many decades. If you're watching this and you're in your 50s or your 60s, you've probably had 30 years of compounding and you haven't paid any tax in those accounts. And the IRS wants to collect their taxes someday rather than never, so they're going to come knocking on your door. And they're going to basically say, hey, when you hit a certain age, if you were born 1960 or before, that age is 73. And if you were born in 1960 or later, that age is 75. So the IRS is going to come knocking as soon as you hit that age, and they're going to say, hey, you got to start pulling money out of your tax deferred accounts. The amount that you have to pull out is your RMD. That is your required minimum distribution. And it's very easy to calculate, and I'm going to show you how to calculate that in just a second. I know if you're looking at the slides right now, the right half is a little confusing because we have all these different beneficiary designations. That has to do with how the accounts are ultimately inherited. That'll be a topic for a separate video. If you want to make sure that you don't miss that, make sure you subscribe, leave a comment, and let me know. But let's go ahead and take a look at the next slide here. So if we want to calculate our RMDs, it is very simple. Let's say hypothetically you hit 73 years old. Great. You now have an RMD in that year if you were born 1960 or before. For most of you watching, age 73 is going to be your first RMD year. Now there's one special rule regarding when you can take that year one RMD that we'll get to on the next slide, but I first want to talk to you about how to actually calculate what your RMD is. So let's just say hypothetically that you have a traditional IRA. Great. We know that you have an RMD because tax-deferred accounts like traditional IRAs have an RMD. Because you were born in 1960 or before, the age for your first RMD is 73. So now how to calculate what your RMD is at that age is very simple. We take the balance of your traditional IRA at the end of the prior year, and then we divide it by what's called your life expectancy factor. And that's based off a table that the IRS has. And we'll put an overlay on the screen so you can see the table very clearly. Now, there's one important caveat. For those of you who are married to someone who is more than 10 years younger than you and is the sole beneficiary of your traditional IRA, you have a separate table. That table is called the joint life expectancy table, and I put a little snapshot of it right here on the right-hand side. Essentially, the IRS has two different tables depending on your age and depending on if you are married to someone who's more than 10 years younger and who's also the sole beneficiary. But for right now, we're going to keep this example very simple. So let's look at an example using Bill here. And we're going to assume he has a 403b. I could substitute that with a 401k, a traditional IRA, a 457, a TSP. All of these have RMDs. I'm going to use a 403b here. We're going to take his account balance at the end of the prior year, and then we're going to divide by his life expectancy factor. Now, Bill in this case is 73 years old, and he decides he's going to take his RMD in the first year. Now, why did I say decides to take his RMD in the first year? Well, it goes back to what I said a second ago. There's one important caveat, but we'll get to that in just a second. Let's assume that his balance in his 403b at the end of last year is $2 million. Well, based on his age, his life expectancy factor is 26.5. So it's very simple. We take the balance at the end of the prior year, divide it by his current life expectancy factor, and that will give us the RMD that he is required to take out in that year. So we can see here, for Bill, he has to take out about $75,000 out of his 403b. That withdrawal will be taxed at ordinary income. Now, the next year, he's going to have a different balance, and he's also going to have a different life expectancy factor. So his RMD will change. So we calculate this every single year, and those are the RMDs that you're going to pull out of your tax-deferred accounts. Now, I want to go back to one important caveat. you can actually delay your year one RMD until April 1st of the following year. So let's take a look at this timeline, and I'm going to look down at the screen now and actually kind of walk you through everything. So here we've got someone, we'll just call her Mary. Now, Mary turned 73 in March of 2026. Great. She can take her RMD in that same year, in 2026, and we would calculate it the same way I calculated it for Bill. We would just take Mary's traditional IRA balance, for example, at the end of 2025 and divide it by 26.5, her life expectancy factor at 73. But like I said, you have the option in your first year RMD to actually delay taking it until the following year up until April 1st. Now, this could be good, it could be bad, it really depends on your situation. But one reason that it might be bad is that, remember, the RMDs don't stop until the balance in your tax deferred accounts are depleted. So if she delays taking her year one RMD until the next year, well, the next year she's going to have 2 RMDs to take, which means that both of those combined are going to increase her taxable income. And remember, everything that's pulled out of these tax deferred accounts is taxed as ordinary income. It's the highest income rate that you'll pay. It's the hardest one to avoid. So you are just basically double taxing yourself rather than spacing it out over each year. So generally speaking, it makes sense to not delay your RMD until the second year, even though you have the option in that first year, because you're going to wind up with 2 RMDs in that second year, which means double the taxation potentially. So we want to avoid that. And when I sit down with clients at DocShop Financial, we go through their RMDs, what their taxes are, and we apply a lot of tax planning strategies, some of them very advanced, to make sure that no client overpays in taxes. One of the strategies that we use is a Roth conversion. And if you want to watch a video on that, just go ahead and click the pop-up that shows up, subscribe. And if you want to talk to me about your personal situation and see if I can help you save taxes in retirement, just shoot me an email, Raul@DocShopFinancial.com. I'd love to hear from you. And until then, take care.